Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for February the 4th, episode 325. I'm Dean Croak, Market Analyst here at DAT Freight and Analytics, along with co-host Chad Kennedy and special guest and longtime friend Chris Orban from Journey TMS. Morning, guys.
Morning.
Morning, Dean.
Yeah, been a long time since we've caught up, Chris. Chris and I go way back to early 2000s. He was one of my very first hires at a company called Fleet Risk Advisors. I think you came out of the pharmaceutical industry. Am I right, Chris?
That's correct. I was working on analyzing pharmaceutical data, and Dean said, "Well, why don't you come and try some of the stuff in transportation? It's way more exciting and way more fast paced." And turns out he was actually right. So it's his fault I'm in transportation really for the last 20 years.
Chris holds the rare distinction of being asked by a CEO of a large trucking company mid-conversation, how is it that you can type 200 words a minute and have an in-depth conversation at the same time?
The quote from a CEO that I remember was, "I'm not sure I really believe in all this predictive modeling stuff, but I'll take a shot." So
I remember Reggie Dupre saying, or someone at Dupre saying, "You're." I think the allegation was we're either on some pretty serious medication or we were the smartest people on the planet. So
at some point he also, and this is very Louisiana of him, he also accused us of voodoo. So that's just what happens sometimes. So
lo and behold, they're a model carrier today, one of the power users of data. Really, so we had a lot of fun. Chris, tell us a little bit about Journey TMS and what you're doing.
Sure. So Journey TMS is a next generation, fully web-based transportation management system, but targeted really at the small carrier market. And I want to make sure when I say small carrier that I'm being respectful, because a small carrier is not a small business. You'll have somewhere 5, 10, 15, maybe even 40 or 50 trucks. So a lot of assets, a lot of people that are working on that business and really driving most of the freight that moves in North America. Y'all would know the stats better than me, but 90 to 95% of the freight is moved by these small carriers. So they're doing a ton of the work in our logistics industry. And we really wanted to give them some of the same tools that the mega fleets, that the legacy TMSs already have, but in a much smaller package, accessible to them anywhere they want via mobile device. And also, priced at a level that is more affordable in those businesses where the margins are so tight.
That sounds exciting. We're going to bring you back a little bit later, Chris, and talk about some of the specifics and how you improve some of those workflows, particularly for, I think, our DAT owner-operator cohort. Some of the key trends we're watching this week in our market update, uncharacteristically, spot rates cooled at month end. It's normally a time when we see a slight surge in volume and tightening of capacity as shippers clear their docks. Reefer rates lost the most ground last week as Protect from Freeze disappeared from bills of lading and ambient temps warmed up, relatively speaking. But of course, all three equipment types are tracking directionally south as they do this time of the year. Capacity is still finding a bottom. Landstar BCO numbers out last week, the lowest in 10 years. Very low numbers. I'm not sure why. Anecdotally, a lot of guys are telling me that there's been a lot of retirements out of that cohort. But management at Landstar note that the rate environment is beginning to turn, but believes the market remains oversupplied. That was Landstar's earnings call last week. Valentine's Day is around the corner. The next 2 weeks will see surging volumes of fresh cut flowers from Ecuador and Colombia arriving in Miami. We'll typically see volumes in the next 2 weeks out of Miami northbound double on lanes all up and down the East Coast and of course west. And rates will go up somewhere between 25 and 30 cents a mile northbound out of Miami for carriers in the next couple of weeks. They typically peak about this time next week. Of course, Lunar New Year is underway. It started last week, running from the 29th to February the 12th. That's resulting typically in a 3-week shutdown of factories. There's a slowdown in volume normally associated with this time of the year, but I had a look at the Marine Exchange data from last week on the number of vessels coming into Long Beach and Los Angeles. The average volume or ships predicted is about 50 in Los Angeles, Long Beach in the next 1 to 2 weeks. That's compared to 35 this time last year. So certainly seeing more volume coming in right now to get ahead of the tariffs, assuming they go ahead. In this week's market update that'll be out this evening at dat.com/market update, we're looking at hydrogen-powered trucks and some very successful long-haul trials in Australia, the Juarez freight market south of the border, and more on South America produce popping up in Philadelphia at the Marine Packers Terminal. and some of the dismal results from agricultural tractor and combine sales from the Association of Equipment Manufacturers. That'll be out this evening at dat.com/market update. We'll quickly go through the load to truck ratio for dry van. Month end typically sees a surge in volume. Volumes are up slightly last week, but there's still an oversupplied market. So the load to truck ratio remained mostly unchanged at 5.99. In the refrigerated market, softer demand this winter is causing load post volumes to be around 4% lower than last year. Reefer capacity loosened. We had more equipment posts in the market last week, more carriers looking for loads. Load to truck ratio ended the week at 8.53. And in flatbed, load post volumes in that market are around 11% higher than last year. They're up 17% last week. Load to truck ratio ended the week at exactly 23.0. Having a look at our year-over-year look at spot rates, capacity eased at month end, as I said at the top of the show, a little bit uncharacteristically. Spot rates dropping 4 cents a mile to a national average of $1.72. Remember, folks, that's excluding fuel, so this is line haul only. Volumes are up 12% though at month end, but capacity eased. That kind of highlights the ongoing oversupplied market on our top 50 lanes based on the volume of loads moved. The average was $2.03 a mile, 31 cents a mile higher than the national 7-day rolling average for all lanes. In the refrigerated market, as temperatures warmed and winter storms Blair, Cora, and Enzo moved out, reefer capacity eased. Spot rates plunged last week following the extreme cold in early January, rates down 7 cents a mile. The national average stood last week at $2.04. It's about 4 cents a mile lower than last year and about 5 cents a mile lower than the year before that. In flatbed, there was no change in last week's national average flatbed rate, which averaged $2 a mile. It's been like that for the last 2 years, and that's precisely where flat rates ended last week again. Line haul rates at that level are about identical to last year and about 3 cents a mile lower than where they were in 2019. All right, let's have a quick look at our forecast today. We're going to start off with our short-term forecast here for dry van before we get into our long terms. These are our forecasts out 35 days. The green is the ratecast, is the upper band, sorry. The blue here is the, sorry, I've got the colors wrong here. The color bands here are bounded by forward-looking error bands. The gold color is the upper band. The red color is the lower band. The green color is the ratecast forecast out for 35 days. Of course, the blue is the 7-day rolling average of historical rates. So remember, these are, again, long-haul loads over 550 miles, excluding fuel, so they're long-haul only. In dry van, we can see that rates are mostly going to be flat out to March 8, averaging about $1.72 mile out to 35 days. Low-case scenarios, rates down 5, high-case up 4. Of course, all this is caveated by the tariff impact or potential tariff impact that we might see. We're not sure how that's going to play out just yet. In the refrigerated market, ratecast has rates down 3 cents a mile out to March 8. That's about what we would normally expect this time of the year, averaging at $2.01 per mile on the 8th of March. Low case has rates down 10, high case has rates up 4. Again, I think where we are right now with the worst of winter behind us, I think the green ratecast forecast is going to be pretty well spot on there before we get into March 8. And that's normally when we start to see some meaningful impact in the refrigeration market from produce season. Of course, we'll have had the strawberry season, Plant City Festival, pushing some more volumes into the market, along with Valentine's Day out of Florida. So that sort of starts the moving the national needle, generally speaking. And in flatbed, flatbed has rates, or ratecast has flatbed rates out to March 8 at about 204, relatively flat. The low case scenario has rates flat and high case has rates up 10 cents a mile. Have a quick look at the long-term forecast. This is our forecast out for 52 weeks. Again, this is spot rates for dry van excluding fuel. The base case has rates sliding into early spring, then starting a systematic recovery back in earnest. The bull case in green cuts that slide short and then really accelerates into the second quarter and beyond. There's a lot of uncertainty in this modeling, no doubt about it. We've got to wait and see what happens with the tariffs and the trade war and any most likely demand destruction that will occur if we get into a full-blown trade war with Canada. The bear case in red is pretty pessimistic. I don't think I'd pay too much attention to that. it has the market bottoming out and staying there. I think we're a little bit more optimistic at that, seeing a recovery in the second half of the year. So that's the forecast for the short and long terms. We'll throw over to Chad to talk about what he's seeing in the contract market.
Yeah, thanks, Dean. So everything that Dean just covered is from a broker to a carrier rate perspective. These rates that I'm showing here from a shipper to carrier or broker perspective, starting with dry van here, our trend lines go back to 2017. At the top in yellow is the spot premium ratio. This is the premium that spot rates have compared to contract rates, currently at negative 1.5. And you can see there the last several weeks, we had that holiday bump up above zero. It seems to have cooled down just a little bit, in line with the same trends that Dean was showing there previously. New rate differential, we've spent the better part of a month in positive territory here. This is a good sign for carriers and brokers as they're bidding on shippers' long-term contract rates. We have seen some increase. This is aligned with what we hear from our shippers, that it's a little bit of a mixed bag when they hold an RFP of some rate increases, some decreases. But for the most part, we've seen rate increases. Even though the last week there, that one data point there, just slightly below 0%. We'll expect this to continue to bounce around and trend up into the right. Contract rate index, slight upward trend to the right there, moving pretty slowly. We expect that to continue out over the next few months. From the new rate differential perspective, the majority of these rates start to go into effect March, April, from what we see in our data. These are large RFP bids that shippers have launched as far back as September and October. They've made their awards, they're preparing for implementation, and those will start to roll out around March, April. So we'll start to see those rates start to reflect the new bids around March, April. Moving on to reefer, same type of pattern here on the spot premium ratio, negative 1.2%. A little bit of a cooling off after the holidays and some winter activity. And new rate differential positive 2%, one of the highest points we've seen in a couple of years. So positive news for carriers and brokers. And that contract rate index, which is 80% of the rates, they're down on the bottom. That's remaining pretty flat. We'll expect that to start to curve up based on what we're starting to see in the new rate differential. And then finally, with flatbed, a lot of variability as we normally see in the spot premium ratio due to a lot of seasonality and short-term lane activity on that spot premium ratio. Still negative 7.2%, so pretty different from van and reefer. New rate differential at negative 7%, not seeing any significant movement there yet. And that contract rate index is pretty flat. It has been over the last 6 months. And then finally there, you can see the inputs to all the graphs that I just showed you. So these are the contract rates, rate per mile trends with the spot trends there in yellow. You can see for the top two, dry van and temp control, a lot of parity there between spot and contract, and then that big difference there between spot and contract for flatbed. So that's a wrap on the contract rates.
Yeah, thanks, Chad. All right, let's bring Chris back in. Chris, kind of an easy question to get you started. What are some of the greatest data challenges faced by small carriers today?
I think it's a great starting point. So one thing I will say is I think everybody in our industry wants to use data as effectively as possible. But when you're a smaller carrier, where do you get that data from? Are you able to generate enough internal data? Well, probably not. Like 5, 10, 15 trucks, that doesn't give you enough kind of base level data to start to draw any conclusions about your business or make projections in terms of where you might expand and find new lanes and things like that. So you kind of start with this sparsity of data, and that's a challenge. So you have to go to an external source most of the time to find that data. And then the other big one for me, I'm a data and technology geek from way back, is what are the tools you're using to analyze that data? And the answer is most of the time Excel and Google Sheets, right? That's what you're going to be plugging your data into and trying to draw conclusions from. And so you don't have the opportunity to take advantage of some of the, and I'll use it, I'll say the word AI, right? Artificial, everybody wants to talk about AI and machine learning and all that kind of stuff. And I want to be really careful to use those terms correctly. But there are very powerful analytic tools out there that can be used on data. And a lot of the smaller carriers just either don't have the people or don't have the time or the resources to invest in some of those tools. They're doing it very, very manually now.
I remember when we started Fleet Risk Advisors, Chris, we went into some of the trucking companies, and I'm not sure you were shocked, but of course they're all using AS400s. and green screens, which was sort of fairly old technology back then.
Yeah, it's absolutely right. And this is another issue, so when you have some of these older technologies and you want to use even some of these less expensive or kind of more accessible modern tools, how do you get them connected? How do you bring the data from an older system into a newer system? And again, it becomes a very manual process, having to take these Excel spreadsheets, maybe even copy and paste. We see this so often with our customers. Oh, not a big deal. I've got my orders and I put them in here, and then I copy and paste them into this system, and then I come over here and I download from my Samsara unit the image of the proof of delivery, and then I send an email out to a shipper to prove that I delivered there. I'm like, well, gosh, man, that's a lot of steps, and you already have fewer resources to do those tasks than some of these mega fleets. It's really an interesting challenge that I think the small carriers are facing these days.
Yeah.
Chris, when I started at a carrier in 2005, we had cards on a board on the wall, and we would move those cards from Florida to Georgia, so we knew where our trucks were.
Sure.
Also got faxes inbound for orders from shippers. Do you still see some of this activity out there in the marketplace?
100%. Again,
Really?
these manual processes, and so what kills me as somebody who really wants to help improve these efficiencies is you're a small carrier, you're running tight already. You need to get that revenue in to buy fuel, to pay your drivers, to pay for your overhead, those kind of things. And if you don't have, forgive me, a couple of $100,000 a year imaging system to get those, validated proof of deliveries back into your system so you can automatically send them to a shipper and get paid within a couple of days. Well, now we're dealing with other things that have to be involved. Okay, so I'm mailing something in, or I'm faxing something in, or as I said before, I'm going through 3 or 4 different steps to get these images back so I can actually validate them. And this just creates issues with cash flow, and you think about some of the solutions that are out there factoring. One of our integrations coming online very shortly is with a factoring company. And Dean and I talked about the fact that there's a bunch of really, really good factoring companies out there. I would love to get as many of those into our system as possible so that we could start offering these services, get these small carriers paid appropriately and quickly so they can keep operating and keeping our stores full, which is what they do.
Thanks,
So Chris, sorry,
I'll yield to you, Dean. Go ahead.
Yeah, I was just kind of picture myself with an owner operator that's like using trucker tools. They may have a DAT1 app with a load board. Paint a picture of what they would do, right? How do you come in, and then I'm assuming you do integrations with all of the different vendors to pull it into one place?
So it's a great question. And when I say small carriers, I mean one owner operator, driver, owner, back office, like they do everything, right? Like so our system supports that. And all we care about is how do we get an order to the stage where you as a carrier can bill for that order as effectively, as efficiently, and as quickly as possible. So first of all, everything is on the web. You don't have to install anything. If you've got a cell phone, if you've got an iPad, if you've got a computer, you can use the system fully web-based. And then to your point, we have integrations with all of our major telematics devices. We're missing 1 or 2, but there's several, I'd say we're 105 integrations right now with telematics devices. Now, we're not pulling in every piece of possible information off a telematics device. We chose to focus really on the trucks, the drivers, the location, and then the hours of service. So, if you wanted to use our system to try to find out what RPM band your drivers have been spending most of their time in to optimize MPG, we can't do that for you. Mega carriers can, right? They've spent the money on those really, really complex integrations, but the small carrier doesn't necessarily have the time to engage with that anyway. So what we want to do is say, look, here's where your trucks are, here's where they're going, here's who's driving, here's what their ETA is based on their hours of service. Let's use this information to allow you to at least start playing in some of these same arenas as the larger carriers. Once we know where a truck is, once we know what's in it, once we know who's driving, we follow that order across the map. We've got, I think, Chad, you were going down the path of a cell phone. So though we're not necessarily messaging and communicating with the onboard computer directly, we are communicating with the driver's cell phone via MMS, via SMS. So we can actually get images from the driver, proof delivery. We can send them trip notes and things like that. We can send them stop notes. We can say, hey, we've got potential weather up ahead. Like all these things that, require these deep integrations. If we can work directly with the driver, then we can get these answers to them quickly, effectively, and they can get information back to the back office very, very quickly.
Is that the majority of the communications right now for the 1-2 trucks is cell phone, not OmniTrax or in-cab?
Oh, absolutely. And again, to be clear, I believe that the long-term solution for this is in-cab communication. I think that's the right way to do it. But most of our customers right now are looking at the cell phone as the primary way they communicate with drivers.
So, Chris, an owner operator that's bidding for loads in the spot market, say, where are they storing their load or the order data now?
The load and order data most of the time in what we see with our customers is in an Excel spreadsheet or a Google spreadsheet or something like that. If they are very, very sophisticated, if they're very sophisticated, they have an account with, y'all or another load board, and they might, keep a list there, that kind of thing. But what's really interesting is there aren't a lot of direct integrations between these load boards. And we've actually gotten feedback from our customers say, look, don't spend a lot of time on those load board integration necessarily. We'll pull the orders out. We'll find the ones we want and get them into your system. We want you working on the actual execution steps. So I think that a lot of these small carriers, because they tend to work on specific lanes, they tend to work in kind of the same areas, they kind of have figured out what freight is going to be good or bad for them, but they also don't know what they don't know. So how do you find that backhaul? How can you, instead of this triangle route you've been running for the last 5 years, should you actually be going, from A to B, B to C, then C back to B, back to A, as opposed to kind of completing this triangular loop or something like that? Really, really interesting analysis that can come out of this data.
Are you doing any sort of benchmarking where you look at your total database and then have a carrier compare themselves to like carriers on a lane or a market?
We are, one of the things that you actually taught me in the industry is that everybody in this industry is the same. They're all different. So, it's sometimes it's hard to get these benchmarks, especially at that small carrier level, because they are very specialized and not necessarily specialized in the sense of, we only haul, explosive materials from Chicago to Dallas or something, but specialized in the sense of like, well, we've got this deal with a carpet manufacturer, and we know we're always going to have, 10 loads a week back and forth on this lane. I'd love to be able to expand and get some more trucks in there, but they're only going to give us 10 loads on this lane. How do I find something else? And that's where the benchmarking can become really interesting. As we build up our community, we want to be able to offer the network effect, right? So 1,000 20-unit carriers looks an awful lot like a 20,000 unit carrier if you've got your data set up properly and can start to aggregate and start to build these larger network solutions.
These smaller carriers, less than 50 trucks, is 100% of their freight through brokers, or do you see a mix of 50-50 with direct to shippers on the head haul and then maybe using brokers on the back haul?
I think your numbers are pretty close to accurate. I do see these smaller carriers using brokers a lot, and we know that's happening a lot. But a lot of them do have these, relationships with one or two key shippers, maybe three, where a lot of their kind of, keep the doors open business comes from. And then they're trying to make their money on some of these other things, or they're making money on their like longer term relationships, and then making sure that they can, try to expand with some other opportunities, or make sure their drivers are happy, make sure they get them back home with some backhauls and things like that they find from brokers. And this is one where, it's something that I've been a huge proponent of for a very, very long time. I truly believe that every carrier, no matter the scale, is also a shipper, and every shipper, no matter the scale, is also a carrier. And by that, I mean that every carrier will at some point have freight that they either don't want to move or don't have the capacity to move. So they need to be able to find somebody else to work through that. Shippers, same way. Sometimes they will have relationships with carriers to be able to move freight, and then they don't actually have freight for them to move. So they need to find the ability to find more freight as well. So this is where brokers are currently playing in our marketplace. I think it's really interesting. I think a lot of brokers do a great job, but are there efficiencies that can be gained by bringing shippers and carriers a little bit closer together by using some of these load boards and the analytics that y'all provide a little bit more precisely, a little more tuned to them, and getting these small carriers access to those tools? I think there's a real opportunity there.
Makes sense. What percent of these small carriers have the TMS implemented?
It's really interesting when you're under that, like 15, 20 unit mark. It's not zero, but it's pretty close to zero. And I'm sorry. I guess what I should say there, every carrier has some kind of operating system. That might be a legal pad and a geotab portal, which is great. Like that, if that's working for you, great. Once you start hitting that 30, 40 unit mark, a lot of them have something. And I would put that percentage somewhere 85, 90% have some kind of tool that they're using. I think a lot of them are using tools that are prior generation, do require a on-prem server or something, which, kills me from a security and from a stability standpoint, because most of them don't also have a technology staff to support that. So what happens when your, kind of landlocked system goes down? Who supports you, who gets you back online quickly? And that becomes a challenge, I think. There is an opportunity here. I think we can add some really neat technology to these carriers for a low cost to them and a low risk as well, right? Like if you're using Excel spreadsheets, if you're using some small databases, things like that, there's not really a lot of risk to moving to a web-based platform and just seeing what's going to happen out of that.
Sure. Chris, one of the challenges we had back in our Omnitrax analytics days was data quality. When it would come to sort of wrangling the data into some form of analytical format, my question is more about staffing. Is there a size where you get to in a small fleet where they start to have a dedicated person on the data side, or is that still a multitask type role?
So it's still a multitask role for the vast majority of people that we interact with. Now, we have had several really, really positive conversations, more at that 50 unit level with a person who is head of technology, but has a really in-depth data background. And then it becomes really interesting to talk about data quality. And we talk about, our data models and, do you have the ability to expand? And can I add things that, yes, very, very easily you can expand a modern data model without having to, pollute your data. But really under that 50 unit mark, there isn't a dedicated data resource in-house most of the time. Some of them might be using outside consultants or contractors, but even that's pretty rare in my experience.
Interesting. All right, this is fascinating. Any other sort of pulling the lens back a bit from the data side of it, any other gems or you've been hearing from carriers out there in terms of what they think is happening in the market?
I think people are fairly stressed. This is not the world's easiest industry, and hasn't been for the entire time I've been here, and I'm sure well before that. I think that there is a concern about what's going to happen in the future and how do you best prepare for it. So one of the things that Dean and I have talked about for the entire time we've known each other is how do you predict events that have never happened before? So, Canada has never been our 51st state. And whether or not you think that's likely or unlikely to happen, the discussion happening, it can cause tension, can cause people to behave differently. And so that's the kind of thing that, how do you predict and prepare for some of these events? Maybe a better example is, I don't know what your rates showed for the city of New Orleans, where I live, a couple of weeks ago, when we had snow that lasted for 4 days. There was snow and the Interstate 10 was shut down the entire time. That's not a normal event, in case anybody's wondering. It's 70 degrees today and gorgeous. So, that was not a normal weather event. I know it disrupted transportation. The city was basically shut down. And oh, by the way, the Super Bowl's here this weekend. So did that impact, stuff coming into the city? Did that impact preparations, things like that? I'm sure it did. So, how do we predict and prepare for these kinds of things using data if they've never happened before? It becomes a real challenge. That's an area where I do think some of the more advanced AI models, machine learning can really start helping us, because they can consider so many potential options so quickly and give you, the human, the ability to pick and choose what events you might want to investigate. You might be able to simulate things. And that's where I really believe that if you can gather enough data about the smaller carriers, who again are moving so much of our freight, are doing so much of this work, then we can start to draw some really interesting conclusions about what's going to happen in North America with our logistics industry.
I just did some quick numbers on it. During that cold period, you just mentioned the volume of loads dropped 60% during that week on the inbound side. Rates went up from $1.80 to $1.85. So excess capacity didn't absorb, or they absorbed a little bit of the volatility. There was certainly plenty of trucks to move that higher volume, but definitely had an impact. Chris, volumes are up about 123% in the last month, up 70% in the last week. So they're getting set for the Super Bowl.
That is and again, I can tell you that just based on anecdotal evidence of driving around and not being able to get anywhere. So
yeah, that's dry van. Of course, in refrigerated, volumes are up about 23% week over week.
Interesting.
So, yeah,
we're also coming into carnival season. Hey, this is a pretty exciting time in New Orleans. If anybody wants to stop by, like there's plenty of stuff going on for the next month or so. So
all right. Cool. Well, it's been great having you on. How can people get in contact with you, Chris?
Sure. JourneyTMS.com is our website. We've got all kinds of information about our TMS. You can actually, and this is one of the things that is a little bit different about us. If you don't want to talk to a salesperson, if you don't want to interact with anybody, you just want to sign up, put your credit card in, and be live on our system in about 15 minutes, you can do that. We won't bother you. But also you can contact us. I'm chris.orban@journeytms.com. You can always reach out to me.
Cool.
And find us on our website. Thank you.
Great. It's great to catch up with you. On this week's podcast with Freightvine, Chris Kaplis is talking to Matt McClelland. He's from Covenant Logistics, talking about emerging technologies, autonomous vehicles, Class 8s, prescriptive regulations. It's going to be a great conversation. It's out Thursday. Next week's show, we've got a friend of ours. Chris knows Tom Cuthbertson, also from Omnitrax Analytics. He's going to talk about ELDs. He's one of the foremost experts on that subject. Chad, you've got some other news you wanted to talk about also.
Yeah, Chris mentioned, we've got a great opportunity in the industry of doing a better job of connecting shippers and brokers to carriers in the right fit. And we've got a new feature in DAT1 called qualification settings. This lets you fine tune your search to carriers that only meet your requirements, like safety ratings, age of authority, insurance minimums, and other factors like that. So we encourage you to go test it out. So you log into DAT1, you go to search trucks and hit qualifications tab, and that should get you where you need.
Yeah. All right. Again, make sure you sign up for alerts to our show. We'll be here again next week, same time, 10 a.m. Eastern, 7 a.m. Pacific. I'll be coming to you live from Australia. It'll be about 2 a.m. in the morning. And that's it for the show. Be nice to everybody. Be safe. Thanks for watching. We'll see you again here next week.